Hello, business finance students. Several of you have asked for guidance on the Minicase. After I post this video, I'll go into Sakai and extend the due date to Saturday to give you time to digest the instructions and submit the assignment, while allowing for network outages on Friday because PLU's IT team is performing maintenance. I'll also give you until Saturday to complete the midterm for the same reason. In this Minicase, we're called to assist Mr. Tarr, CFO of Sheetland & Halyard, Inc., on selecting among alternative proposals: a contract to supply duffel canvas to the U.S. Navy, or selling shorefront land in Pleasantboro. There is an idle factory on the land in Pleasantboro. If Sheetland & Halyard wins the Navy contract, it would use this factory to make the duffel canvas, so the company can't do both. This is what we call mutually exclusive projects. We need to determine the net present value of each proposal so Mr. Tarr can make the right recommendation to the rest of the management team and to Sheetland & Halyard's board. The information we need is in the Minicase, but it requires some interpretation. So here's some guidance on how to get to a solution. First, set up an Excel spreadsheet. Copy the information from Table 9.2 into it. The Navy contract would run for 5 years, and the table has what we need to determine cash flows each year. Table 9.2 doesn't have the initial investment Sheetland & Halyard has to make in year 0 to get the idle factory ready. So set up a year 0 column. Your spreadsheet should now have 7 columns from left to right. A description column. The first row from Table 9.2 reads yards sold, so I think you get what I mean by a description column. Then a column for each year from 0 through 5. The company has to refurbish the plant and buy new equipment in year 0 if it's going to pursue the Navy contract. So find the amounts in the discussion above Table 9.2. Remember, this is a capital investment, so the cash flow is going out. The company also has to invest in working capital at about 10% of sales, according to Mr. Tarr's estimate. This needs to happen so the factory can start making duffel canvas, meaning it's an outgoing cash flow in year 0. And the way you'll determine that is what are year 1 sales? Compute 10% of that. That's the upfront investment in working capital that the company needs, in order to make the duffel canvas, because it has to make it before it can sell it. So now year 0 is set. Next, we need to look at depreciation. I know it's shown in Table 9.2, but it's shown based on accounting rules, not really for what we need for cash flow. Depreciation doesn't directly affect cash flow, except that it is a tax deduction. However, as we see in the chapter, the Tax Cuts and Jobs Act provides for bonus depreciation, essentially allowing the company to expense its year 0 capital investment for tax purposes. This is good for the company as it gets the tax benefit up front. So you'll need to recalculate income for all 5 years. Start with operating cash flow as shown in the table. Then subtract the year 0 capital investment to get year 1 income. But don't make income less than 0. Tax code doesn't allow this. Instead, we have to carry the unused bonus depreciation to the next year and the year after that until it's used up. So if there's capital investment left over, subtract the leftover amount from operating cash flow in year 2. Then recalculate income tax each year using the 30% rate. I know the book says the rate is 21%. But just assume the rest is state and local taxes and we'll be fine. You should now have what you need through years 0 through 4. In year 5, the contract ends. The company can now sell the land. Mr. Tarr thinks the company can get $600,000 for the land today, so you'll need to determine the future value of the land at year 5, net of the 30% tax. In year 5, we also recoup our initial investment in working capital because we won't buy any more raw materials to make duffel canvas, so add it back. By now you've set everything up so you can compute the project's net present value. Do this using either the NPV formula in Excel, recommended, or the formula in section 9.1 of the text. Use the 12% discount rate given in the Minicase. Now, look at immediately selling the shorefront land at the $600,000 Mr. Tarr thinks it's worth. The buildings on the land are fully depreciated, so Sheetland and Halyard will owe tax on the entire sale amount. Subtract tax using the 30% rate. The net value of this alternative is $600,000 less tax because the company would sell the land in year 0. Now, which deal looks better? The Navy contract or selling the land for $600,000 now? This is the analysis Mr. Tarr was almost done with. And then, a developer offered $1.5 million for the land in Pleasantboro. If accepted, this sale would also take place in year 0, so the only thing you need to do is determine the after-tax value. So at the end, does the Navy contract look better than selling the land for $600,000 today? If the land sale looked better at $600,000, it looks like an even better deal at $1.5 million. If the Navy contract looked better compared to the $600,000 sale, how does it look compared to a $1.5 million sale? So those are the questions that you need to answer. Good luck, and let me know if there are any remaining questions or concerns. Thank you and good luck.